All right, stocks finished the week really strong today, and really good follow through the last couple of days from the post FOMC rally that we had on Wednesday. So we're going to break down this potentially trend changing move that we have right now. Very similar patterns that we see to the end of other corrections like we have right now. Again, 2018, even COVID, 2015, 16, 2011, very similar patterns. But I'm also going to compare this move that we had, this little rally, was very strong rally over the last, 20 some odd days, to the March rally, and see what similarities we're seeing there and whether or not this move has some legs to it. Because ultimately that March move, as good as it was, and it was pretty darn good, did not have the legs to it. So does this one look any different than that March rally? So we're going to break that down to see what's driving this action and whether or not we have some good risk on asset class and sector movement here this week. And then our trade idea as a stock, that if we are going to end up rallying up to new highs by the end of the year, we have a stock that should give us a pretty good returns if that's the case. And we'll talk about how to trade that. So let's go ahead and get started. Today is Friday, July the 29th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel, hit that thumbs up icon, like our video down below, comment on the video, join our website on MarketScholars.com, click on that link up there, follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. Also, if you're watching us on our blog, check out these things over here, on some of these things over here on the right. Click on this heart icon down below the video on our Market Outlook tweet. Hit that like button. Same thing with the Facebook post. Hit that like button as well. Doing that helps us get our content out to more of our followers on those platforms. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. And you can see really good move to the upside. The biggest gain above the 30-day moving average that we've seen. Like, it eclipsed that March 29th move. In fact, you had to kind of go like outside of COVID, which, remember, kind of throws off a lot of things, right? Because we went so far down. So outside of COVID, you have to go all the way to get further above the 30-day moving average than we are right now. You have to go all the way back to 2021, and we were pretty far below the moving average there too. We got 13% below, but you got up above. We got up to 8% above the 30-day moving average, coming off of that low point right there. When we were coming off of the post-credit crisis low, we really rallied significantly up to, from where we were 6% below up to 8% above. Outside of that, the COVID, that's the only time we've been bigger. We were coming off a bear market low point there, as well as in January of 2009. Kind of a brief bear market rally, but even the correction low point, when we rallied off of the correction low in that bear market stage, we didn't get this high above. So it's not very common to get this high. You can see back over here in 2002, again, these are all at the end of bear markets. These are all bear market rallies. Again, I don't think we're in a bear market yet, so I don't think this is a bear market rally. I think this is still a correction, and that we are either forming the correction low here, and this is our correction move higher, or we're going to do the exact same thing we did in March, where we don't quite get to a higher high. Remember, this is the last intermediate high point, so this would be the current intermediate high point, and we've retraced 50% of this intermediate move. So we are hardly up to a new intermediate high, and we're not even really above the last intermediate low point. The last intermediate low point's right there, right about that 23% Fibonacci retracement level. Which is not very far away, 4,200. It's only 70 points away. We're up 57 points today. So it's not very far away to get there. But that's, needless to say, this is a strong rally. In fact, I bring up this oscillator here, the DMI, quite a bit to kind of say, okay, this is a pretty decent sized move. That's a breakout move to get above 34, to get below 20. Again, that's bigger than what we saw in March, right? We didn't get down to 17. We didn't get above 31, but look at the 7-day. Like when I cut the DMI in half, check this out. Look at the 7-day move, and this is pretty darn parabolic. Like, we are almost below 10. We got the 10.05, 10.06, and we got all the way up to above 44. So again, that's again bigger than what we saw there, and we saw a pretty decent sized move up to 44 and a 7-day move up there, but without the downside move in the negative indicator. And you can see the ADX is rising. ADX is lagging, so it actually will keep rising even if we peak at these levels. So we've gone parabolic in a short time frame, a very, very short time frame. We've gone pretty parabolic here. Again, you can see it's not very common to get positive moves higher. We did there at the end of 2021, right before we peaked, right? We got up to 44 in a short time frame, of course. There in November 2021, we really took off. There's been some other peaks, but you can see there's not very many with that also combined with the red arrows, and this is one of them. We're almost got, the orange arrow center at the bottom, just about getting below 10. In fact, barring a collapse on Monday, we probably are going to get below 10 on that. So a really good move to the upside. We have in the last 2 days broken above the 38% retracement of the current intermediate decline, which is really important because that's our current intermediate decline, right? So we've broken above that, and we've broken above the 38% of the market sentiment decline. So two kind of significant resistance levels we just broke in the last 2 days. So really, really good move from that perspective. Like it took a good move to get there on Wednesday, and then Thursday and Friday, 2 successive breaks with some pretty decent sized gaps too, at least on Wednesday and then today, to get us through. If you look at the weekly chart, you can see the near-term line, again, very similar to what we saw here in this June level. The near-term line also got up to 90 there. I got up to 90 this particular time as well. I remember in March, the momentum and the near-term line both got up to pretty much 99. So, it's not out of the realm of possibility. And the intermediate line's a lot lower than it was in March. It's a little bit higher. We got a cluster. We're coming off of a cluster, a weekly cluster, and we're almost, we're just a little bit above that 2.5% mark to the moving average on the weekly chart. Light green shading because we're rising. We're just not, obviously in bullish territory yet, and we'll see if this near-term line, again, the last near-term line peaks we got here, we followed up with some really small ranges. Very small range, those two, and then that was reversal. Very small range on the week of May 30th, and then the reversal. So let's see what kind of range, if we end up getting a really, really small range again, that in this case would bring that momentum line down. So you can see that one brought the momentum line down without really getting to overbought levels. This one, the momentum line dropped to extremely oversold levels just in those 2 months. Actually, it was kind of 3 weeks of very, very low. And then the fourth, the reversal, very low range because of the gap there. So that's what the weekly chart. This is also the end of the month. And you take a look at the monthly market forecast. It's kind of interesting to see here too. We got light pink shading in the yellow line. Now light pink shading in the yellow line here, when you can see through those lines. Getting this pattern, let me just show you the last time we got that. We got that here on the month of, so this would have been the month of June that we got it. We got it here in the month of March 2020. You can see the rally coming out of it. We got that here in the month of December 18. Look and see the rally coming out of it, producing clusters. We got that here in the December of 15. You can see the rally we had coming out of it, multiple clusters. We got that over here in September 2011. Now we didn't get the pink shading for a little bit longer, but pretty much light pink shading and yellow line combined there. You can see the rally we got coming out of it with some clusters there. Let me get rid of some of these lines here. Get rid of that one and get rid of that one. So we had some clusters coming out of that one. So you can see getting light pink shading. If I were to go all the way back out to say like 1970 on this, getting light pink shading and a yellow line. So here's 1990. You look at the good move. This is a monthly chart, mind you, so it's not very common to get this. But we got it there. We got it here in 1987. We got a good move coming out of that. You got the light pink shading. Didn't quite get the yellow line in 84, but you got the light pink shading there. If I go out to early 80s, you got light pink shading, and then so this was a bear market, a very weak bear market, but that's your failed correction bounce coming off of it, and we rolled over. Let me just show you really quickly this bear market. There's the pattern we got there, the failed correction bounce, and then bear market. The pattern, light pink shading yellow line, failed correction bounce, and then rolled over, right? So, but all these others, we just, all these others that were corrections, we just kept going. Failed correction bounce, rolled over. Here's 73 and 74, light pink shading yellow line, failed correction bounce, and then the bear market, right, to the downside. So you can see how, it at least produces, the light pink shading yellow line at least produces the correction bounce. Whether or not we end up continuing higher remains to be seen. Of course, for us, the important level is this 4,200. Getting above 4,200, not just by a couple points. You got to get above this black line, which is the 23% retracement of the the previous market sentiment rally. You got to get above this green line, which is the at least above the green line, if not above. Really, you need to get above 44.25 because that gets you above the black line. It gives you above this 62% retracement of the long-term move, and then this 78% retracement of this intermediate run. So if we can accomplish that in the next month or two, that's then by the end of the year, bull market going into, as you can see, coming off of light pink shading yellow lines leads to some really good returns. The intermediate line the intermediate line's not down very far, so it's not like, it's still easily in bullish territory and has been pretty much since the last bear market. Again, you can see the bear markets on this monthly chart. They stand out. The intermediate line gets out of bullish territory. We have not had it. It briefly got to, where did it get down over here? It got to 59. But we were already 3 months off of the low by the time we got to 59 with the near-term line in bullish territory. So hardly a bear market there. You can see the obvious bear market here and here. We actually got a cluster at the end of that one. We came really close to a cluster there at the end of this one as well. And then you come out to the 81, 82. We did get out of bullish territory. We briefly dipped into bearish territory, just briefly, while we were still bearish. So bear market by that definition. And then there's your 73, 74. Very obvious, right? And a little bit of one in 77, 78 as well. That would be this one right here with light pink shading. Didn't quite get the yellow line, but that would be our failed correction bounce. A couple of months, and then we fell into bear market. But very, very weak there. About as weak as one as you could possibly get. So obviously we're not that way right now. In fact, we're 6.5% above. Like, we did not dip below. You can see this is the 2.5% mark below the 30-month moving average. And we did not dip below. We dipped below a little bit on COVID, but not very much. You can see it. You can see all of these over here, all the corrections. That's about where we dipped to. Even the initial corrections of the of bear markets. That's about where we dipped to before we bounce, and that's where we dipped to this time. And so far has bounced. And again, to really break through this and get going to the upside, we need to break through. Get above this 4,200 level and really get above 42. Get above 4,200, get above the black line and this green 62% retracement. You feel in the 50% of the market sentiment. So you get above this conglomeration between pretty much 4,200 and 4,250. Get above that area, and then now you have a good chance of getting all the way through. Otherwise, resistance, you expect resistance to hold, of course, until it doesn't. Now let's break off into some other long-term charts. Good bullish candle on the Hakinyashi. The 10-week is rising, PPO is rising. Again, you can see how big. This is one of our bigger bullish Hakinyashi candles that we've seen in a while, right? We had a pretty decent sized one there in November, coming off of the election and vaccine low. So we got a really good sized candle there. We got a really good sized candle about this size in March too. So again, this is very similar. There's a lot of similarities to what we're seeing right now to what we saw in March. A lot of similarities. So again, just getting to this point doesn't do anything because we've been to this point before earlier in this correction, and that didn't resolve it. So getting to this point doesn't change it. We have to get through this point, like we did not do in April there, and we rolled back over to from a lower intermediate high to a new intermediate low point, and this would obviously be easily a lower intermediate high point, and you can see it, like I said, is still below that low point. So you would expect that we would get to a lower intermediate low, even if it's just barely slightly lower. You would expect that we would get to a lower intermediate low if we do what we did in March and April, if we do that again here like we saw then. If you take a look at some of these other oscillators, let's take a look at like the DMI. I showed you that getting above 30, below 20, good sign. The RSI got us above 60, got us to 65.9. See over here in March we got to 65.2. So again, similar. We got so kind of a quick break off of a lower high point on the CCI. As of right now, it's still a lower high point here on the RSI. So it's a good move, kind of a washout move to the upside. Here it was kind of a 4-day rally up after a couple days of weakness. Here's a couple days of weakness, and now we've had a really good, strong 3-day rally. In fact, probably one of the stronger 3-day rallies that we've seen. Let me pull up the rate of change, and let's see, we were up the last 3 days. Let's go to a 3-day rate of change here. So we are up. In the last 3 days, on the broad market, 5.34% roughly. So right there. So if I zoom out, you can see we've had a couple others. They're in May 27th. We were just a smidgen higher, 5.5%, and that was the peak. Here in March, we had, coming off of that low point, we had a 5.7%, and we ended up diverging there once we actually got to May 29th. And then you can see going back out here in October, coming off of the Halloween low point, November 2020. Again, this would be the election and vaccine, or this actually be the election. The vaccine news came over there on the 9th. But coming off of that election, we had a good rally off the Halloween low point. Of course, COVID, you're going to get, when you're so low, you're going to get big moves there too. But even like, again, coming off 2019 lows, we didn't get this is a pretty good rally. 3 days. It's not very common to get this bullish, especially when we are not on a bullish trend. When we're not coming off of, the other thing too is we're not coming off of a major VIX peak. In fact, the last 3 days, we're coming off of the VIX being at 25, like the May 27th or whatever. Where was that? Let's go back to that May period. Let's see here. So the rate of change. Let me bring up the rate of change again. All right. So this got there on my own. So May 27th. So we were coming off of this kind of late May, and then March 16th we were coming off of this pre-FOMC peak. So what do we say? Mid-May, May expiration roughly. Well, coming into May expiration, the VIX was at 30, was in the 30s, and we dropped down with that rally. So that, hence why we had such a good move to the upside, because the VIX was so high. And then what was the other one? March. It was like middle of March. So right here we were in the low 30s as well. If you look at the VVIX, again mid-March, right into this area, the VVIX was about the 130s. 125. In May, mid-May here was also 125, and right now we're coming off of 85. Right, so it's a little surprising considering how low the VIX and the volatility of the VIX is. It's a little surprising to get which in my opinion makes the move even that much bigger than it actually is, because it was more than just one standard deviation. Okay, so I put up on the Analyze tab here just how unlikely it was. So here's where we were at the close of the 26th. So the open of the 27th, 3 days ago, so 27, 28, 29. So essentially the same thing as the open on the 27th. This would be the close of the 26th. We closed the 26th at 390.89 on the SPY. The VIX was 5 points higher at the end of the 26th. So now here we are. This would be the open of Saturday morning. So it goes through the close of the 29th. It was a 1% probability. Based off of that setup, there was a 1% probability we would have closed at 411.99 like we did today on SPY. A 1% probability, which is more than 2 standard deviations and a little bit less than than a little bit less than the 3 standard deviations. So in other words, that's a pretty decent sized move for where the VIX was and where the volatility of the VIX was. That's what makes this move even bigger than other 5.75% moves over 3 days, which again kind of makes it even more parabolic when you look at it from this perspective. Now the question is whether or not it has staying power. And one of the things that I tweeted out, if you follow me on Twitter here, I tweeted this out earlier today. See, not this one, no, not that one, this one. So back in March, when we had that good rally, this is the on-balance volume, which measures the volume for these, and kind of a summation of the volume moving up. And you can see that the volume, the on-balance volume, even though we got the higher highs compared to the peaks I've highlighted, we did the volume, the on-balance volume, did not get the higher highs. So there's a divergence there, which means that's not nearly as bullish as we think it is. In fact, see that low point there in January, we are actually well above not only those 2 highs, we were actually also well above that low point. But you can see the on-balance volume was not above the low of the volume on that day. So it kind of goes to show that we were, again, not nearly as bullish on that peak as what we thought we are. Well, we're seeing that now. This is a great rally. It's a really, really good rally, as you saw. A strong move that we don't see very often, and it was even stronger considering where volatility was when we started this past 3 days. And from a volume standpoint, you notice the arrows I've highlighted. We are not above those peaks, but we are easily above those peaks in the price. We are not even close to being above that low point on the on-balance volume. See, we're well below that low point, but we are easily above that low point on the S&P. So again, according to the volume, we're not nearly as strong, and that's kind of what I tweeted out here on this next indicator, that you can see the monthly range, which I can't, it was like, was it 41? Yeah, 41 points, 41.99 points. The monthly range and the volume was easily the lowest of the year. Easily the lowest of the year, despite the fact that we get a light pink shading and yellow line, and we had 3 red arrows. Again, very similar to the to light pink shading and the green line. Well, 3 red arrows is also a really bullish signal, especially on a long-term basis. When you get the light pink shading and yellow line, and you get 3 red arrows, it tends to be pretty bullish. You saw it here, you saw it here, you saw it all the same ones, and you can see the failed correction bounce over there as well, and you just see it's all across the board. That's a very bullish signal. But again, we're not. You have to kind of confirm this bounce with the green arrow that we just got by continuing higher the next month. And for us to continue higher above 420 would be really, really important. The problem is this is the first time that we were below average on that next month. All the other times that we bounced, we were easily above average on the volume. Easily above average on the volume. This is the first time that we bounced with pretty much easily below average on the volume. I mean, not even close to average on the volume there. So another thing that kind of stands out to, you wonder just how bullish we actually are. Again, the VIX is really low. It dipped below 90% again. Like we dipped below 90% last week too at the end of the week. But we did not dip as low as we did last week. Even though we're lower on the VIX relative to the VIX 3M is not lower. And again, the VVIX, as we mentioned before, is at 80 is in a pretty extreme low point for where it's been in the past. Now that we can look at a monthly chart again, the last time that we finished near 80 on the monthly basis was the beginning of 2019, and that was kind of the point where volatility started to rally higher. That's the last time. The last time that we dropped to 80 was that first quarter of 2019. Now we were pretty bullish throughout 2019, but remember, from fall of 18 to COVID, we were in a bear market. We just didn't realize it here in the United States because of the FANG stocks masked that weakness. But small cap stocks suffered. Bonds rallied. Bonds were the best performing asset class during that period. I mean, if you look at the asset class comparison chart for 2019, just 2019 alone. And this would really be from that month right there. So from March 1st on, when the volatility, the VIX started to rally, and really it would go all the way through to the end of March 2020. But there, I mean, for that year, the end of this 2019, you can see the Qs mask what was pretty much weakness, right? Like equities were up, but not very much, and gold and bonds outpaced everything except for U.S. equities, and SPY really benefited from the Qs. You go all the way out to where the VVIX finally peaked, and at the end of February of 2020, so the end of that month, you can see bonds and gold were the best performing. Qs pulled back; they were still pretty darn good. S&P pulled back, but look at what commodities did. Look at IWM. I mean, this bear market, that we saw really was not nearly as bad as it could have been because of these mega cap names that actually, were almost up 20% in that 1 year period. They really helped risk appetite, even though bonds were up 29% and gold were up 20%. So it's pretty rare for those two asset classes to be so bullish and have equities be relatively bullish too, because of the Qs. The Qs are basically acting as their own safe haven trade, as international stocks were really suffering during that period. Okay, I did mention that we did have some gaps here, so let's go over here. We did have some gaps on Wednesday, and that was a really good potential for a runaway gap. Really, our runaway gap would be over here on the 19th. But we had a pretty decent kind of gap there, which would be kind of a runaway gap. It would be more like a breakaway since we ended up closing well up here above that prior week's high point. But then we got today's gap, right, which we haven't closed at all. So keep that in mind, that today's gap probably is a common gap. And we are well above the value area in the 4-week range with very little volume below us. Because we moved up so fast the last couple of days, it's very easy to come in and fill that in. So, which would fill in that gap. And of course, the important thing to watch is whether we fill in the gap from Wednesday. Because if we do, then that's going to be a pretty decent fake out pattern, where it looks like basically like March 29th, right? If you go out to the March 29th time frame, it would be over, I don't know how far back, so I have to go over here. So here's that March 29th high, and it looked like we were pretty darn bullish, and then eventually once we started to fill in that gap, we weren't that bullish anymore. So that's kind of what we saw with that 29th gap, a really good sized gap there, that eventually we kind of filled in a little bit right off the open, but finished really strong, but then that was it, right? So we'll see if this ends up being something similar, where we fill in this gap first, and then potentially come all the way down to fill in that gap. Which if we do, again, we'd be breaking through, be back into the value area, we'd be breaking through that hump of volume, and we'd be down into an area of volume where we wouldn't be so bullish, right? And then the 19th comes back into play as a potential fill to the downside. So very important to watch how we deal with this lack of volume below us over the next few days, whether we can really hold this and break through these Fibonacci lines to the upside above 420, or if this area ends up being a resistance and pushes us back in the other direction. What do you think? What do you think of that? Do you think that resistance is holding? Do you think we're, like Tom Lee says, a fun strat, that we're going to move all the way up to 4,800, so back up to new highs by the end of the year? What camp are you in, and how bullish do you feel with this week that we've had, with this move of this last 3 days that we've had? Do you think that this is the real deal? Share with me down in the comment section below. Either way, and what's driving your thesis on that? What charts or indicators, besides what we've looked at, are kind of helping drive how bullish or not as bullish as you are right now? Share that with us in the comment section down below. All right, now let's take a look at what's driving this price action here. And this is the week. This is how we've done all week long, and you can see that really the weakest performers all week, the only thing that has been negative all week, and it was the Qs early. But the Qs really rallied by the end of the week and ended up here along with IWM, SPY, real estate stocks, and commodities, right? They were all up with bonds being down, and we're down most of the week for closing right at the low. I mean, it really dropped at the very end of the session. Yields took off, and then the dollar ended up being down. Emerging markets, despite the weakness in the dollar, emerging markets suffered today from China, some weakness in China, and then developed markets, kind of really lagging behind developed markets, and mainly just because of today. It's today, emerging markets really deviated away from everything else, and gold rallying on the weakness in the dollar mainly. You can see since the dollar started to drop post FOMC, gold really took off, and you can see there's the FOMC meeting. So everything is pretty flat except for commodities. Commodities were a little bit higher post FOMC, but you can see the move the stocks made post FOMC. They went from pretty much break even for the week, gold to break even for the week, to significant gains, like I said, in the last 2 days, and then with a pretty decent gain coming out of the FOMC meeting. Remember, the Qs were negative going into FOMC Wednesday. They were negative, and by the end of the day, they went from being down 2.5% for the week to being up 1.75% for the week, just like that. So, and then of course continuing that move higher. So let's take a look now at some of these, especially like bonds and bond yields. Bond yields were interesting. They were at a close. Did they end up with a cluster on the daily chart? Let me see how they ended up on the daily chart here. They did. So they ended up with a daily cluster on the which we haven't seen a daily cluster in a long. In fact, this is the first daily cluster all year long, and we were pretty bullish here. We've had a couple of declines. We only had really the one here into oversold territory. So this is the first overbought cluster that we've had since this area here in July of 2021, and we're kind of just starting. Like over here, we were at the end of a bearish move, dark pink shading and red line. Here we're kind of just getting started on a dark pink shading and a red line, kind of very similar to what we saw in 2020 when you started off a bearish period with some clusters and then ended up going even further. Now that was COVID, but ended up going even further. And kind of same thing over here. You started off a bearish period with a cluster, and you ended up, starting, again, there's our bear market that we were in, because, again, bear markets, people think that we're in a bear market over the course of this year. Bond yields don't rally in bear markets. Like if I were to go out, again, to say like 1980, and take a look at, bonds performance. So there's the bear market, right? And again, we didn't realize how much of a bear market that was because of how bullish the Qs were, as you saw in the other chart. But that's a bear market. You can see 15 and 16 was a pretty decent global slowdown with that strong dollar that we saw. Then there's 2011, 2012 that prompted QE3, and then there's your bear market there as well in 2008, 2007 going into the end of 2008, and there's your 2002, 2003. That's what yields do in bear markets. They drop. They don't rally in bear markets like they did going all the way into this week. And right now, it looks like they're starting to pull back, right? On an intermediate term basis here, on this current run that we've been on, we're now down below that 38% with a cluster, right? With potentially starting a bearish move with a cluster. So we might just be starting the correction / bear market right now, with yields finally starting to drop a little bit. Of course, again, if the Fed has to raise rates and drag the 10-year yield up with it, because right now, if the Fed raised rates as they are expected to by 50 basis points, 100% odds according to the futures market, if they did that, they would be above the 10-year yield where it's currently at. So if the Fed's going to raise rates, they might end up having to bring the 10-year yield up with it, because the 10-year yield, remember, is influenced by economic growth expectations. And if there's no economic growth potential, like there wasn't in the late 70s with all that inflation, then you're going to end up with this situation here, where the Fed funds rate is higher than the 10-year yield for years, right? Over this period of time, the Fed funds rate over from 1978 for a brief period in the 80s all the way through to the pretty much to the end of that bear market in 81, 82, the Fed funds rate was above the 10-year yield. The Fed, like if you look at when they were raising rates, like they were raising rates here in 1978 and bringing them up. In a brief little period of well, here in 79 as well, they were raising rates all the way up until a brief period of time in 80 where they dropped rates from 20% all the way down to 8%. But again, in 1980, they were back up to 20% by the end of the year, and they were back up to 20% by 81, a brief period down, and then raised them again in 82 at the beginning. So, they had to, like, the Fed funds rate was well above the 10-year yield, and they were still raising rates. And that was not the case in the 90s, right? In the 90s, the Fed funds rate was always easily below. And by the time the Fed funds rate caught up to the 10-year yield, the Fed stopped raising rates and we went into recession. So, here we are again. The Fed funds rate's almost up to the 10-year yield. And then we saw that even with COVID, we started a brief recession there. But here we are almost back up to the 10-year yield, really, really close. And we'll be above at the next rate hike. And they might have to just keep going like they did in the late 70s, right? They might just have to keep going here and keep raising and bring the 10-year yield up with it, because the 10-year yield did move higher. Let's see here, where is that chart? I have there we go. The 10-year yield did move higher during those rate hikes, right? They eventually went up too, but the Fed was dragging it up. The economics growth potential wasn't there, but the Fed was just dragging it up. As it basically, we were at one point in time over 5% above the 10-year yield the Fed funds rate was. I don't know if we'll get necessarily 5% above, but again, don't be surprised if we don't get a few percentage points above, which we haven't, like, this was the highest we got. We got nearly 1% above at the end of 2006, and we got about 1% above here at the end of 2000. To get 2.5% above, we haven't seen since 1970 and 1978. So it's going to be really dependent upon how much longer the Fed's going to keep raising rates. And considering two things, number one, the real Fed funds rate is still extremely low. Like when you look at it compared to the Fed funds effective rate and the CPI, it's still historically low. This is going into the end of, now this will be updated here for July, but we'll take a look at it here next week. But it's still historically low. It's lower than what we saw in the 70s and the 80s. So that screams that the Fed still has to raise rates to get back up into positive levels. The Fed still has to raise rates. That's number one. And number two, the financial stress index continues to be at its lowest level ever. Let me just refresh this page. Yeah, it's down below -2 now. It's been updated here this week, and is even lower now than what it was at 1.8. So it's down below -2. It's never been below -2. So in other words, the Fed has plenty of room, right? The Fed will stop raising rates when there's too much stress in the system. In addition to also the Fed funds rate, the real Fed funds rate, finally getting up to positive levels. You can see this is where they stopped raising rates, when the real Fed funds rate got up to strong positive levels. They stopped raising rates over there. The Fed funds rate was at real strong positive levels. The real Fed funds rate is not at 2.5%. So there's still a long, even in the 70s and 80s, you can see they kept raising rates because the real Fed funds rate never did get up to strong levels until finally they broke it. They broke that inflation rate. And then inflation finally fell below the Fed funds rate and stayed there for decades, right, through all the 80s and through all the 90s. Let's take a look how the sectors performed this week. And this was an interesting pattern too. Let's take a look at just just this week alone. Again, XLK, XLY, XLC, right? That's who you want to see lead the way higher here. Energy was our biggest, up 10% this week. Energy was up. Energy was already really strong going into the FOMC meeting. Utilities were too. Utilities ended up being the second best performer. Industrials were the third best performer. XLK and XLY barely outpaced energy or real estate, only because of that late spike in yields, that late little rise in yields at the very, very end of the day today. Otherwise, you would have had those four winners: energy, utilities, industrials, and real estate would have been your best four performers. That's not really who you want to lead the way higher when you're really bullish. You would like to see XLK, XLY, XLC be your big winners, and they are showing some good pattern. I mean, dark green shading, green lines. XLC not so much, right? There's XLI, XLF even has the cluster. It's the only one with a cluster here. Well, you got one in staples yesterday, and you got one in real estate yesterday, but some dark green shading and green lines all across the board, even in XLC. Not quite there in energy, but remember, energy had the biggest gain this week, so it's pretty close. So you're pretty bullish here. We'll see how bullish this continues to be, whether or not, like for example, XLK is going to end up holding its resistance level, again at that 38% retracement and at these old lows. So really important to see if this will be able to follow us through when we're already 9% above the 30-day moving average or not. We spent a lot of energy just to get to this point. Again, looking at the DMI for XLK, and then you split that in half to kind of look at this very short term, the very, very short term moves, and you can see, we're almost kind of diverging with the higher lows on the negative indicator, but really, really higher. I mean, that one of the highest peaks during this time, higher than the March peak, easily higher than what we saw over here. So very strong move with a very low negative indicator. Again, how much are we going to be able to follow through on this when it took so much of a rally just to get to these resistance levels without a lot of volume supporting it? It's one thing not to have volume supporting it. It's another thing, not have the cumulative volume pushing you through and still not getting, from a new highs and new lows perspective, you're still not getting up to positive, right? We're still not above zero yet on the new highs, new lows, despite how bullish we are. At least over here in May, June, we did briefly get above zero. And in March, we did easily get above zero. But this go around, we're not above zero yet. And when you look at like the trend, you can see why the volume situation doesn't look so good. The unbalanced volume is because, we ended up being at 0.98 by the end of the day. We were at 1.4 for most of the day, above 1.3, 1.4. So there was a lot of negative volume. Not as much on the positive side, more on the negative side. And that's kind of why we're not seeing a very good bullish picture on the volume picture to support such a tremendous rally that we've seen, not just really over the last 3 days, but if you were to go back all the way to, that low point, so this is a 29-day period that we've been rising. We're up over 12.5% over this 29-day period. Again, outside of COVID, that was way bigger than what we saw in March and April. Much bigger move to the upside. In fact, again, coming off of that 2018 low was really the only time that we've been anywhere close to that kind of move, right? So if you were to put this at 12.64, again, over the last how many years? 20 years. So again, that 2019 low, coming off of the 2011 credit crisis rally, and then coming off of bear market lows. Like even coming off of these lows, we didn't get a 29-day period this bullish. Again, these are coming off of bear market lows too, bear market rallies. So again, it's very similar, either coming off of significant correction lows, or it's very similar to a bear market rally. The question is, which one is this going to be? All right, so for our trade of the other day, if we are going to be in a bullish mode, we want a stock that can really take advantage of that. And I wanted to take a look at Target. Target has really turned things around since its earnings disaster last cycle. And we do have earnings coming up here before the August expiration. It was a disaster, right? But we're back at the highs of the period. You can see we're almost back up to the gap there. Dark green shading and green line on the market forecast chart. You can see on the weekly chart, as bearish as we were here, we have a green line. We have bullish Hakunashi candles, a rising PPO at very, very low levels. We have 3 green arrows. Oops, we here, sorry. We have 3 green arrows on the MACD, stochastics and moving average. We are easily above the 17-day period, and the MACD is bullish. The MACD has been above its moving average for quite some time. It just took a while to finally get and stay above the 17-day, and once it did, then it finally took off, right? And it got to the 50, kind of held, back towards the 17, and now has rallied back up above that level. And so, here we are about to break into easily above the 50-day moving average. The 8 and 17 days have crossed above the 50-day moving average, and you're at the bottom of the value area for the past year, and you got this tremendous, like, big time gap in volume here that we can easily move up higher, up towards, like, say this $200 level, the top of this Fibonacci retracement, where we got down to the 62% retracement and have since rallied back up into it. So that's a pretty good move, if not above the 200 level, up towards the 200-day moving average, and up towards 210. Again, at the very least, just to fill in this gap. So there's a pretty good move potential. You look at its CCI and RSI, they're looking bullish. You look at its DMI pattern, it's looking bullish. Right, you look at the Keltner channels with the Bollinger Bands, they're looking bullish, getting outside the Keltner channel. So really good bullish all the way around. So what we decided to do here with the really good potential for directionality is buy the at the money call option with that 50% stop. So right click, buy custom with stop, put their stop order at half of that, so 435. So now it gives me about $435 risk if I get stopped out, which is right in that $500 risk wheelhouse that we typically take on these directional trades. And so there's our trade idea for today. So this is what it looks like. Again, we're risking roughly $500 if we end up getting stopped out. But if we make it up to $200, we're looking at about a $2,600 gain. If you get up to 210, you're looking at about a $3,600 gain off this one contract. So for $500 of risk, we'll easily take that reward if we indeed are turning things around and we're that bullish again. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new threads there with any questions or comments you have. Apply to anybody else's thread. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com. Subscribe for free. Follow me on Twitter, or excuse me, like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.